tax planning in retirement. Specifically, what are things that retirees can do to pay less taxes so they can keep more of their hard-earned income? We're going to cover a special rule that applies to Social Security income. That rule is called the Provisional Income Rule. When someone receives Social Security, the amount of taxes, or I should say the amount of that Social Security benefit that is subject to tax, depends on their other sources of income. It's not automatic that Social Security benefit is going to be 100% taxable. For example, if somebody had no other income source in retirement, they were only receiving Social Security benefits, that benefit would not be subject to income tax. On the other hand, if somebody had large distributions from their IRA account or rental income or even tax-free municipal bond interest, all of that income would affect how much of their Social Security benefit is included in their taxable income. One of the great things about being in retirement is that you might have extra flexibility to determine your taxes compared with when you were working. Retirees often have different types of, what's called investment accounts. You might have pre-tax accounts like an IRA, as well as a brokerage account, like a joint brokerage account or in your own name or a trust account, or maybe you have assets invested in a Roth IRA. And depending on where you pull your cash flow from in retirement can have a huge impact on how much you pay or don't pay on your Social Security. So we're going to take a look at a case study for a retired couple. And in this case study, we're going to look at the impact of someone who takes all of their portfolio distributions from an IRA, and what would happen if they took half of that amount from an IRA and half of it from a taxable brokerage account, to see the impact that that'll have on the retiree and their taxes.
Okay, so now let's look at an example of a retired couple and the impact that taking income from different sources can have on how much taxes they pay or don't pay, and specifically how being really thoughtful about where you take income from, what accounts you take it from, what effect that has on the amount of your Social Security benefit that is subject to tax. So in our scenario, this retired couple, they want a total amount of cash flow before taxes coming into the household of $100,000. So $50,000 of that is coming from Social Security benefits, and then on top of it, they're taking out $50,000 from their investment portfolio. So with this couple, they have some money that's invested in pre-tax accounts, like in this example, an IRA, and they also have money invested in a after-tax brokerage account. So for our scenario, let's see how what would be the impact if they take all of that money from an IRA, or in scenario 2, what if they took half from the IRA and half from the brokerage account, and what that looks like from a tax standpoint. So let's go line by line and see what sources of income they have. This first column here, this is our scenario 1, and this is our scenario 2, just to kind of keep track. So in scenario 1 and scenario 2, the first couple items are exactly the same. So because they have a brokerage account, whether they sell investments in their brokerage account for income, they still are going to have to recognize dividends. And so I included some qualified and non-qualified dividends for this example. Now this is where the differences come in. So in scenario 1, you can see that they're taking out $50,000 of distributions from their IRA. In scenario 2, they're only taking out $25,000, and the remainder is coming out of their brokerage account. Now, because you can control what you sell or don't sell in a brokerage account to either recognize capital gains or recognize capital losses, for this scenario, I'm showing that they're not recognizing any gains or any losses, but if those did come into play, yes, they would impact how this is calculated, either for better or for worse from a tax standpoint. Now going on to Social Security, the household has a total of $50,000 of Social Security benefits coming in between the couple. Now this is where I think it's pretty remarkable we can see the difference. Taxable Social Security. In scenario 1, of the $50,000 they're receiving, just a little over $40,000 of that is subject to tax, where in scenario 2, less than $20,000 of that Social Security benefit is subject to tax. So we can see already that by we can already see how provisional income, how this is already having a huge effect on the income that this retired couple even needs to report on their taxes. All right, now looking at the two examples, in scenario one, this retired couple has an adjusted gross income of $100,000, just over $100,000, and in scenario two, $54,600. They have the same standard deduction, and because they're over 65, you can see if you're looking at this, you might be saying, hey, that's a little bit high of a standard deduction, and that's because if you're not at this point yet, once you're over age 65, and if you claim a standard deduction for every member of on the tax return over age 65, you're able to claim an extra standard deduction per person, and so that's why these are higher. So after we subtract the standard deduction, taxable income just over $70,000 and just shy of $24,000. Looking at the federal tax bill, in scenario one, they are paying $7,300 for federal taxes. In scenario two, $1,800, just under $2,000 per year in taxes. So this is what really blows me away, is that there's so many financial advisors, planners, accountants, financial services people that do not take the time to go over this with their clients. And this is such just low-hanging fruit. Any financial professional that has that's working with retirees, if they're really doing a good job, they're going to take the time to look at these rules and see how it impacts their clients. You can see that, in this situation, we didn't reduce the cash flow that this retired couple is able to enjoy. All we did is we were thoughtful about where they took it from. Now, obviously, not every retired couple has money in different types of accounts, but a lot of retirees do. And so anybody can take the time to do this planning and run scenarios to see if is there some low hanging fruit? Is there an easy way that we can save a few $1,000s on taxes? So this is from a federal standpoint, saving about $5,000 per year in taxes. Now, I ran this for the state of Utah. That's where I live, like I said. But looking at this, I have clients in multiple states, and every state tax rules are different, but they're similar. And so this is almost always going to be beneficial in any state that you live, but it depends on the state. So looking at the state of Utah, you can see that same thing. This retired couple is going to they're going to save another over $2,000 a month in state taxes by doing this. So simple planning, by understanding provisional income, by understanding the tax rules, I call them tax superpowers for retirees, you can have a huge impact on how much of your income you get to keep and how much has to go out, be sent to the IRS each year. So, and if you're like me, the less that we can pay ethically and legally, then let's take advantage of those. Let's take advantage of the tax law, and let's take advantage of that. So,
all right, so as you can see from our example, the decision to take part of your income from another account, or simply the decision to be thoughtful about where you're pulling income from in a given year, can have a huge impact on the amount of taxes you pay or don't pay in retirement. Thoughtful planning can go a long way. And as you can see from our example, it's more than just looking at one area of retirement in isolation. It's not just about looking at taxes or your investments or your health insurance or anything else. You really need to look at everything together, because when you combine all of these things into a comprehensive retirement plan, it can have huge, huge benefits. So I hope this has been helpful. Catch you next time.